Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that will be discussed is intended for information and educational purposes only and should not be considered investment advice or investment recommendation. As I scroll through the comments feed on the Almost Daily Dividends pie over on Trading 212, there's a growing trend of people getting into something they seem to not fully understand. Firstly, it's the never-ending war against the people asking what the yield is or why their dividends haven't come in yet. Despite that being in the FAQ in the description, this should be read before investing. But more recently, there's a new problem. People investing in equities or the stock market that don't really understand how investing works in the first place. Let's take a look at a recent post so you can see what I mean. What's the point in investing in this risky pie for only a 3.2% return if the stocks don't tank, which the currently has, when you can keep the money in a savings ISA and get 3% return with zero risk? Now, there are fundamental problems with this comment in almost every part of the sentence. Risk is not binary. It's not a case that some things are risky and some things are not risky. So calling it a risky pie is in a sense nonsensical, as there's a spectrum of risk in anything you invest in, so it really depends on what you're comparing it to call it risky. It's not a 3.2% return, that was the previous dividend yield calculation, and you can see the AAR in the description, but there's no set level of return that you're guaranteed each year. Investing in stocks never works like that. There is not zero risk in a savings ISA, there's also other risks involved. For example, you're highly exposed to inflationary risk if you're keeping money in a cash ISA for the long term. Your money underperforms inflation and the risk of your money actually decreases over time. But the main point I want to address is the implication that because stocks have currently, in the poster's words, tanked, it means that this is a general trend. There are a few comments on this that I found from a quick look just now. I'm still in the red on this pie. The value is getting pretty hammered lately. I've recently invested and I'm currently down 5%. Is this something to be concerned about? Here's to another bad day. I understand that as a new investor who doesn't have the background knowledge on investing, seeing red in the portfolio may be a little unnerving to you. Your money seems like it's gone, perhaps even disappeared forever. It's scary, I get that. No one actively wants to lose money, especially nowadays when it doesn't go as far due to the cost of living crisis. The amusing thing, however, is that if you scroll just a little bit more further into the pie's history, you'll see a completely different picture. The pie was one of the few things that did decently well in 2022 and kept many people's total portfolio afloat. It's also what led to its massive growth in popularity in 2022. As I make this video, there are approximately 58,000 active copies in the pie. Here's what the majority of the comments were like just a few months ago. That was a nice jump the pie did today, things are looking good. I just want to say a massive thank you to the owner of this pie. I'm currently up 8% and I couldn't be happier. Thank you so much for creating this pie. I follow you on YouTube as well and I always look forward to the updates, thank you. And then very recently, after all the negative and panic comments of the last couple months, there was this comment. Doing well this week, eh? So what can we make of all this? It's a tale as old as time. When the stocks go up, people get euphoric. Nothing can stop them, king of the world. When stocks go down, the pitchforks are out, the accusations start flying around and the portfolios are sold at a loss out of fear. Serious investors don't do this. What they know is that the historical data consistently demonstrates that over the long term, stock markets tend to generate positive returns. Despite short-term market fluctuations, the overall trend of the stock market has been upward. Long-term investors who stay invested have the potential to capture these long-term gains. Now, does this guarantee that you will make gains investing in the Almost Daily Dividends pie? No, I can't guarantee that. It's the catch with investing in equities. Although most of the time you'll probably be a winner, stocks do in fact go down. If you're picking individual stocks, there is a risk that your investment will go to zero or never reach a higher price than the price you invested. So how do long-term investors stay calm during short-term falls? The first thing you need to be aware of is that volatility and market cycles are essentially you paying the cost of making money in the stock market. Financial markets naturally have ups and downs. Prices change due to various factors like the economy and investor sentiment, and long-term investors know that short-term drops are a normal part of market cycles. They understand that markets tend to balance out over time, and investments can recover and grow. You need to make sure that you have the mindset of a long-term investor. Long-term investors think very differently than short-term speculators. They focus on the long run, understanding that investment success is not defined by daily fluctuations. Instead, they look at the overall growth trajectory over time. This patient and disciplined approach helps them avoid getting influenced by short-term market noise. Long-term investors also have clear financial goals and an investment plan aligned with those longer-term goals. Before you're investing, you really should know what your reason for investing is. If you don't have a target or a goal, it'll be much easier to convince yourself that you need to sell, as you're not working towards anything specific. Longer term investors know that small price drops don't fundamentally change their long-term prospects, and instead of worrying about short-term falls, they stay focused on the bigger picture, knowing that their investment can provide significant returns over extended periods. There are benefits of staying calm and not panicking at any little change in price. While short-term falls may worry some investors, long-term investors stay calm and composed, and they understand that reacting emotionally to market movements can lead to irrational decisions that harm their wealth. By staying composed during these downturns, they avoid selling in a panic and protect their investment capital for the long term, seeing the fall in price as an opportunity to buy more shares. Short-term falls present a chance for long-term investors to buy more shares at lower prices. Instead of being concerned, they see these declines as an opportunity. This strategy, called dollar cost averaging, lets investors lower their average cost per share. In the long run, this can potentially increase the overall returns when the market eventually recovers. What if you're still worried? The other point I wanted to make in this video, that it could just be the case that investing in stocks isn't for you right now. This sounds like a harsh statement or that I'm being unnecessarily mean to you, but it's a serious thing. It might be the case that moving from the relatively safer savings to a relatively riskier investing may not actually be right for you at this particular time. Here are some things you should really consider and questions you should be asking yourself. Setting clear investment goals. What are your financial objectives and the purpose of your investments? Are you saving for retirement, a down payment on a house, or another specific goal? How can establishing clear goals help guide your investment decisions and create a framework for your investing strategy? Remember that having a clear goal in mind will really help prevent you from selling at the wrong time when you're scared, as you'll know deep down that you're undoing your progress so far. Secondly, understanding your risk tolerance. Have you assessed your risk tolerance level? How comfortable are you with fluctuations in the value of your investments? Are you aware of the inherent risks involved in stock market investments, including the potential for losses? Have you considered factors like your financial situation, investment horizon, and emotional capacity to handle market volatility? A lot of the comments I've seen in the chat are clearly not comfortable with the level of risk they're taking investing in the pie. Now personally, I wouldn't be concerned until we see drawdowns of around 15% for this particular pie. Since I created it, it's been nowhere near that level, so I'm not concerned and haven't been. Your situation could be well different to mine, and may even be willing to take more risk. Happy to explain more if you're curious about anything specific there though. Thirdly, educating yourself about investing. Have you taken the time to learn about the basics of investing in the stock market? Are you familiar with fundamental concepts such as diversification, asset allocation, and risk management? And for those that are not sure where to begin, I'll hopefully be launching my own course later this year or perhaps beginning of next year, assuming all goes well, which should be really helpful to give you a solid footing and getting your wits about you when you invest. Next, starting off with a solid financial foundation. Before diving into the stock market, have you ensured that you have a solid financial foundation in place? Have you paid off high interest debts? Have you built an emergency fund that covers several months of living expenses? Do you have a budget in place to manage your expenses? There's no good investing your last pound into the stock market if you know you're going to need it a week later. Having money that you need or can't afford to lose going up and down in the stock market is way more stressful than just investing the extra money. Determining your investment time frame. Have you considered your investment time frame? How long do you plan to stay invested? If you have a long-term horizon, such as several years or more, how can you potentially benefit from short-term market fluctuations and compounding returns? If you have a shorter time frame, how might you need to adjust your investment approach to protect your capital? Investing gurus and other smart finance people say that you'd usually want to be investing for at least 5 years when you begin investing in stocks, as this should hopefully give you a long enough time period for the good times to outweigh the bad times. Now, did you answer yes to most of these questions? Well, the ones that were yes or no questions, I mean. If you did, then ask yourself, why are you even looking at your returns every day? You're investing for the long term, aren't you? The prices are simply going to change every day. Heck, look at the results of the almost daily dividends portfolio. The bottom ranking stock kept swapping around. It was funny that I'd get questions asking if I was thinking of replacing a stock that was underperforming that week, only for it to go up 10% the next week. Imagine if we swapped it out in a panic. But what about if you answered no? Well, that might mean that you're not ready to invest yet, or you need to reorganize your portfolio, or build a lower volatility portfolio that better fits your risk tolerance. Right now, as you may have seen, the rates on savings accounts are at a multi-year high, but savings accounts aren't the only way to stash your cash right now, and I made this video recently that can show you 4 very different ways to hold your cash right now. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!